Today's screencast presentation will focus on adjusting journal entries. So what are adjusting journal entries? They are entries made in the general journal to record revenues that have been earned and expenses that have been incurred. It occurs at the end of each accounting period after a trial balance has been prepared. So there are 5 types of adjusting entries. We have the deferred expense, accrued expense, a deferred revenue, an accrued revenue, and a depreciation expense. So a deferred expense is when a company pays the cash before it incurs the expense. Let's say on December 31st, BC Display had $200 worth of art supplies at the beginning of the year. They purchased an additional $350 worth and had $120 of art supplies remaining. So how do you calculate this amount? So you have your beginning inventory, add your purchases, and less your ending inventory. This gives you an amount of $430. Therefore, you debit your art supplies expense and you credit your prepaid art supplies of $430 each. An accrued expense is when a company incurs expenses and pays for them later. Let's say BC Display borrowed $1,500 from North Bank on July 1st. Interest rates are 6% and is paid after 6 months. Record the adjusting entry for BC Display on July 31st. So how do you record the amount of interest? So you would have your $1,500 that was borrowed, times it by the interest rate, which is calculated as 6 divided by 100, and you times it by 6 months, which is out of 12 because interest rates are usually calculated annually. Therefore, you have an amount of $450 interest. Therefore, you debit your interest expense of $1,950 and you credit your interest payable of $1,950 as well. So this amount was derived from adding $1,500 with the $450 of interest. So deferred revenue is when a company receives cash before they earn the revenue. Let's say on December 31st, BC Display had completed a portrait drawing for which the customer had paid $75 last December 1st. So therefore, you would debit the unearned revenue of $75 and you credit the service revenue of $75 as well. So an accrued revenue is when a company provides a service before receiving cash. Let's say on December 31st, BC Display bills a customer $500 for art classes performed last October. Therefore, you would debit your account receivable of $500 and you credit your service revenue of $500 as well. Lastly, your depreciation expense is when a company spreads out the cost of a non-current asset over the duration of its lifespan. Let's say on December 31st, BC Display recorded $2,000 of depreciation on the printing machine. So therefore, you would debit your depreciation expense of $2,000 and you credit your accumulated depreciation of $2,000 as well on the printing machine. That's it for today. Thank you for listening.